Hello, welcome to our monthly performance monitor. My name is Barney Hawkins, Investment Director at True Potential. Just when we'd got used to the idea that global growth would inevitably mean higher interest rates, the markets have paused for thought. In the UK, a slowdown in the economy meant that May's expected rise in interest rates, considered a near certainty in March, didn't happen. In the Eurozone, a similar drop in output was witnessed. Japan, too, slowed unexpectedly, and emerging markets were sideswiped by the threat of higher interest rates in the US, a slowdown in China, and a good old-fashioned economic collapse in Venezuela and Argentina. Only in the US was there a positive surprise. However, even here, the market's reaction was muted, with analysts either discounting the figures or exercising caution over how long they could be sustained without the one-off boost from the recent tax cuts. So where does that leave us now? Well, for the most part, the global growth story remains intact. Central banks may have exercised caution in not raising rates this time, but the direction of travel remains unaltered. Opinions differ on whether the Bank of England will hike in August or November, or both, but there remains little doubt that rates will rise at some point later this year. In the US, the bumper reporting season has partially vindicated some extravagant ratings, particularly among the tech giants, but there's a feeling that while the pace of growth may be slowing, it is to an easy canter from an unsustainable gallop. America's fortunes are inextricably linked to those of the global economy and vice versa, so barring a global slowdown, the US remains attractive, albeit with a currency viewed as susceptible to weakness in the face of growing trade and budget deficits. In Europe, a degree of caution has crept in around Italy. Italy is a net contributor to the EU, but because of the unlikely coalition between the right-wing League movement and the populist Five Star Party, the country now has Europe's first Eurosceptic government. By contrast, in spite of a slight tremor in some of its economic numbers, Japan is continuing to benefit from buoyant conditions, and we remain positive. The UK still divides opinion. Valuations are attractive, lower than Europe and certainly the US. Sterling, too, is regarded as an undervalued currency. However, the fog of Brexit hangs heavy over the UK, with much of the investment community awaiting greater clarity around the terms of departure before committing. Among investors, there's undoubtedly a sense that we are late in the cycle. After almost a decade of economic growth and rising markets, how could we not be? The tax cuts introduced in the United States appear to have had an immediate effect on corporate earnings, but there's likely to be something of an aftertaste as interest rates are raised to cool an economy already running hot. And this will be felt around the world. But much depends not on the magnitude of these effects, but the pace at which they occur. The markets can cope with change, but don't like surprises. Now, while we're undoubtedly in the autumn of this particular cycle, the recovery has been shallow and faltering. There's no sense of euphoria, almost none of relief. However, it's precisely this caution, this restraint, that's reassuring, and with global growth still very much on track, interest rates around the world remaining low, tax rates hardly punitive, and inflation under control, this economic autumn is likely to witness a prolonged Indian summer. Thanks for listening, and we'll see you again next month.